Suzlon is one stock that is up almost about 5%. So let's talk about that. The company reported a very strong performance in Q1. Their order book was strong, highest deliveries in Q1, while the wind turbine generator margins also saw a stellar jump. To discuss more on this, we have Himanshu Mody, the CFO of the Suzlon Group, who's joining us now to talk about that. Himanshu, good morning and thanks a lot for joining in. You know, it was a very strong order book that you saw. The revenue growth was quite healthy, almost a 50% jump is what you saw year on year. So I just want to start by asking you about, since the budget was the big event behind us, anything from the budget for your sector, anything that could boost demand and investments?
So clearly, I think, even beyond the budget, the sector has seen a lot of policy push from the government. Renewable energy as a sector is clearly on the radar. We're working towards a target that has been set by the regulators of increasing green energy inputs. So whilst there may not have been anything specific per se in the budget this time, but clearly, I think from a larger policy push perspective from the government, renewable energy sector is one of the priority sectors. That is very evident.
Okay, so that's on the budget. Can you tell us a little more about your own business? It was a very strong Q1. And can you give us a sense of the WTG deliveries that you had? How did it pan out? Any deliveries from the last quarter that spilled over into Q1? And what is the way forward in terms of Q2 and Q3?
So we did about 274 megawatts in Q1 in terms of delivery. Of course, this is for the quarter, so there's always be a spillover from one to the other, but that's just the phenomena. So 274 is what we did in this quarter from April to June. And our order book currently stands at about 3.8 gigawatts, which we need to deliver over the next, I would say, 18 to 24 months. So I think the outlook, it's fairly positive, and now the execution will start to play out. FY24 for us largely was consolidation of our balance sheet and getting the working capital in order for execution of the order book. FY25 for us would largely be focused on P&L and the deliveries that we need to make out of our order book.
Okay, all right. Hi, Mr. Mody. Good morning and good to see you again. And, the stock saw a bit of a re-rating, but I think post these numbers, the street has got a little bit more confident as well on your deliverables. So let's talk about first the industry on the whole. The government has been talking about 10 gigawatt of, wind capacity addition on a year-on-year basis. For this year, though, how much do you expect the industry to add? That's FY25 as well as FY26?
So we, as an industry, added about 3.3 gigawatts in FY24. Our sense internally is that the industry would do around 4.5 to 5 gigawatts in FY25. Difficult to put a number for FY26 as yet, but I think certainly 4.5 to 5 gigawatts for the industry in FY25 should be doable.
And you would have close to around 30% of the market share. So if I extrapolate that, you'll be at around that 1.3 to 1.5 watt. Gettable number, right?
Yeah, so that's, of course, our historical market share has been around that ballpark. What FY25 holds, of course, time will tell.
Yeah, that's why I try to get it out the other way. So we are extrapolating that number and let's see how things progress. What about the O&M side of the business? How much does it contribute as of now? And margins over there are relatively better. How do you see that scaling up and the impact on the consolidated margins?
So margins there continue to be strong, about in the early 40s, so anywhere between 42 to 43, 40 to 43% is where we are seeing operating margins on the O&M business. That's, of course, a steady state business for us. Currently annualized revenues are close to about 2,000 crores, which historically in the overall pie have been close to about 25 to 30% of the overall pie. But as the WTG business keeps growing year on year, whilst the absolute number on the O&M will also increase steadily, but the overall share in the consolidated would decrease. And that would have an impact on the consolidated margins because O&M margins are certainly higher than that of the WTG business.
So what does it mean on margins from year on? You've gone up to around 18% as I see of the past quarter. Given the change in the mix, though you'll have some kind of operating leverage as well that could play out. what should be the number we should work with on an average for the year?
So, as I said, on the operating margins for O&M, about 40 to 43% is something that definitely is achievable. And
On the consolidated front?
No, I'm talking about the O&M. On the
Yes.
consolidated front, similar ballparks definitely is doable.
17, 18%, you can hold on to it, right?
Yeah.
Okay, all right. Also, if you could tell us, give us some color on the order book composition. As you said, it's looking very, very good. Break it up for us and tell us whether the better margin business will start now getting executed, which in turn, though your mix is changing on the O&M side of it, but, if the number of contracts you're executing is a better margin, that's what could support the profitability going ahead.
No, I think WTG margin contracts are pretty much, I would say similar pricing. There's nothing same pricing, but similar pricing and similar margins. Of course, operating synergies and efficiencies, economies of scale will start playing out over the next few quarters as and when we execute. But from a sales perspective, I think, our contracts are similar in pricing. Whatever operating efficiencies by cost management we can achieve, that is what will result into healthy bottom line.
Okay, well, Himanshu, we'll leave it there. Thank you very much for your time. Stocks up 5% and market likes, but of course, what you've done. Appreciate it. We'll take a